Hi, everyone. Thank you for joining East Daily's webinar this morning. We're going to give it a couple minutes and then we'll get started. Just want to give everyone time to finish dialing in and setting up. Thank you. Hello, everyone. Thank you for joining today's webinar, Musical Chairs, the Permian G&P Deal Frenzy and Who's Left Standing. My name is Ajay Bhakshani, and I lead the Capital Intelligence team here at East Daily. As you guys have questions, please feel free to submit them via GoToMeeting throughout the presentation or reach out via the email listed here. We will not have a Q&A session, but we will make sure to follow up individually via email, so please do not hesitate to ask. For those of you who are new to East Daily, to put what we do simply, we provide actionable data. Whether you want the raw data or organized data sets that are delivered directly into your model, or full research reports and models that analyze the data, it's all going to be available on our platform, Energy Data Studio. Feel free to reach out to me or visit our website if you're interested in more efficiently digesting oil and gas data. Depending on your needs, we have a variety of product suites that have the answers you're looking for. Most importantly, I want to say that the data we provide is not in a vacuum. You have access to me and the rest of the team, whether your question is about commodity exposure for a company or what the next pipeline out of the Permian is going to be. Now, going on to the topic du jour, I want to start off by revisiting our M&A thesis from our annual report. We highlighted the improved financial position of the midstream sector, and one specific subsector and theme we called out was G&P and the value of a vertically integrated NGL business. Certainly this year we've started to see some of this play out. Next, we're going to discuss the 3 Permian G&P transactions that happened in May. Note, we'll be doing a deeper dive on the latest one, Energy Transfer and WTG, during this webinar. However, we've also prepared materials for Kinetic Durango and Phillips 66 and Pinnacle as well. Those will be available in the appendix section of the slides, which we'll send out by the end of next week. Finally, we're going to explore some of the private G&Ps that remain. Again, for the sake of time, we're only going to dig into one, but information on the others will be available in the appendix. So we showed this chart in Dirty Little Secrets, and the main takeaway here is really that midstream has been ripe for M&A. Our coverage went from almost all generating negative free cash flow in 2019 to positive free cash flow in 2023. Part of this was driven by lower CapEx needs. With broader production growth slowing down, you also just end up needing less infrastructure at a time. We're seeing it now in the Permian with the Permian gas egress pipelines. In 2019, we had GCX, Permian Highway, and Whistler all getting built at roughly the same time. But now we're sort of doing one new build at a time. Right now it's Matterhorn. We're probably going to need another pipe in about 2027. A lot of potential options out there, but only one is likely to move forward. Another reason, again, for the lower capex is also just regulations. Good luck getting another pipe in the Northeast or another DAPL built. Midstream has and needs to continue instead to focus on maximizing the assets already in the ground. Also, over the last 5 years, Midstream has been laser focused on paying down debt. Leverage targets continue to decrease, some even dipping from 3.5 to 3 times now. And this overall allows a lot more room in the balance sheet to lever up if needed for M&A. And again, given the high free cash flow generation we're seeing, we expect most midstream companies can quickly reduce leverage as well. Our thesis for more M&A has already started to play out. Some of it's on public firms, some on privates and individual assets. For the most part, these large caps are still well within their leverage targets, and these deals have been accretive to cash flow. So despite the flurry we've already seen, we truly believe midstream's only getting started. And in DLS, we focus more on M&A between publics, and we've already started to see that this year with NuStar, Equitrans, and even those early rumors around Western. Our analysis, however, applies to privates as well. The same motivations and M&A strategy that we explored before between publics can be achieved by going after specific assets and PE-backed companies. One acquisition strategy in particular is vertically integrated NGL companies doubling down on G&P, whether that's creating a dominant position in the second-tier basin or just simply increasing your market share in the Permian. When we look at the big 3 Permian NGL names we cover, Energy Transfer, Enterprise, and Targa, we found that they can essentially double G&P earnings by transporting that NGL barrel they process, fractionating it, and then exporting it. On top of that, having a dominant G&P position has allowed some of these companies to build a nice runway of downstream growth projects, even when production growth overall might be slower or there's space on competing pipes. Enterprise's acquisition of Navitas is a great example. After acquiring Navitas in early 2022, the company quickly announced a slew of processing plants in addition to the ones that Navitas was already in the process of building. That in turn led to Enterprise announcing an expansion of their Chinook pipe by 275,000 barrels a day, which they then eventually replaced with a new greenfield pipe, Bahia, that's going to be 600,000 barrels a day. They announced those NGL expansions at a time when NGL egress utilization out of the Permian was only 80%. So despite what seemed like an unconstrained environment, Enterprise was at least able to leverage the growth that they saw on their own G&P systems into growth in other parts. So some other types, but again, Enterprise's interest to keep those NGLs within their own system, and Navitas helped them do that. Now, back to the recent deals. There's been about 13.3 billion of M&A over the last 2.5 years, where publics have bought up PE-backed single basin G&P companies. One thing to note on this chart is the multiple. So Permian is expected trades at a slight premium. One factor driving that, though, is that these systems are not only just in an attractive basin, but they're competing very well within that basin. All of the Permian G&P deals had expansions ongoing during the time of acquisition. In Lucid and Navitas case, those platforms were actually used as a system for more growth. So Enterprise went on to add 900 million cubic feet a day of capacity to Navitas. We only track about 230 million cubic feet a day of planned expansions of Lucid, but Targa actually connected that Lucid system to the rest of its Delaware system, where they've gone and added more than 1 BCF a day of capacity. So just as Lucid and Navitas boosted Targa and Enterprise's downstream NGL assets, we see a similar strategy with 2 of these recent deals, WTG and Transfer, and then Pinnacle and Phillips 66. three latest deals that all happened in May, we wanted to focus on NGL production and expansion capacity. Each deal increases NGL production, gross gas volumes, and capacity by double-digit percentage points. ET especially boosted their system by acquiring WTG, and we're going to dig more into that shortly. Even Kinetic, though they're more of a pure play G&P, they still own a stake in the Chinook NGL pipeline and could benefit from those additional Durango volumes. Chinook's actually partially owned and operated by Enterprise, so there might be risk if Enterprise diverts flows to its wholly owned Bahia pipeline when that enters service. So Kinetic, through its acquisition of Durango, could maybe divert some of those NGLs and help backfill those volumes on Chinook. I also want to highlight again that these are also active and rapidly growing systems, and this additional capacity drives a significant portion of the value for these deals. Pinnacle, for example, it seems like it has low utilization, but in reality, we expect that they're offloading a significant amount of gas to Targa right now. We estimate that there's almost 10 Pioneer rigs on that system. So when that expansion does come online in mid-2025, we expect it's going to fill up pretty quickly and double those volumes. And that's going to mean over 50,000 barrels a day of NGLs that Phillips 66 can move on to its Sandhills pipeline and Sweeney fractionators. Similar story with Kinetic and Durango. Durango is essentially full, and they have another plant on the way. And the ramp up of that second plant is a major part of the deal economics here. I believe a little less than half the purchase price is contingent on that expansion. So assuming a fast ramp of the Kings Landing plant, that's 40,000 barrels a day of NGLs can eventually move to Chinook. The other element of this deal that I just want to quickly touch on, Durango clearly needs capacity. It's essentially full, and Kinetic's legacy system has that space. So although those two systems aren't really connected right now, there could be some opportunity for rationalization there. Kinetics also has been trying to expand into Eddy and Lee counties in New Mexico, and that's where Durango is especially dominant. So that acquisition is really an acceleration of their strategy. Now, digging more into the Energy Transfer WTG deal, ET already had a strong legacy system in the Midland, but activity has moved further north towards Martin and Howard counties. Transfer system has been full, which speaks to its high quality, but it also hasn't needed to expand significantly in the last few years, which again speaks to its lower growth. WTG has two systems in the Midland. There's a less active one in the South Midland, and then the Crown Jewel in the North Midland. In a way, ET's position in the middle could help connect WTG's two systems and further utilize any existing capacity. That North Midland system is also, again, in that core area of the Midland where we're seeing a lot more activity these days. Looking at the counterparties, Transfer's top producers in the Midland include Exxon and Endeavor. Interestingly, WTG's top counterparties include their acquiree and acquirer of those two firms, so Pioneer and Diamondback. So thanks to the producer M&A, there is overlap in these two customer bases, and that actually might help Energy Transfer ensure it maintains its market relationships with those producers. As we saw on the last slide as well, the acquisition greatly boosts Energy Transfer's volumes in the basin. We expect some of those NGL volumes are already traveling on Energy Transfer's Lone Star pipeline, but given WTG's interest in Bangle, we expect a lot of its growth volumes are going to move on that pipe instead. We actually found out last week that ET will not be able to proceed with the acquisition of the 20% stake in Bangle due to a right of first offer provision. So that's actually going to reduce its original $3.25 billion purchase price of WTG by $175 million. So now there really is more incentive for ET to move those WTG volumes onto its Lone Star pipeline. Now, Bangle itself is expanding, and WTG likely committed its growth volumes to that pipeline, considering it owned a stake in it. But there's still a lot of existing NGL production on the system that transfer might be able to move around. Another benefit for transfer may actually be on the gas side with its proposed Warrior pipeline. So WTG gives them much more exposure to two of the largest Permian E&Ps, which they might be able to leverage to get more contracts for the project. So the acquisition here might extend beyond just NGLs and into ET's gas ambitions as well. Now, that leads us to looking at what Permian G&Ps are left. For starters, it's important to note that the Permian is not as fragmented as people might think. The 8 public firms owned about 75% of capacity before these last 3 acquisitions. We're only looking at the integrated players like Targa, Enterprise, Transfer, Phillips 66, and MPLX. They owned about 55% of the processing capacity. After these acquisitions in May, that number is now 82% for the publics and 61% for the integrated midstreamers. There are some significant systems contained within this all other category that takes up about 10%, but those are the producer-backed systems like XTO and the Devon Howard JV. Of the remaining private systems, we wanted to focus on ones with significant enough growth, significant enough size and consistent rig activity. The ones that stood out to us were Brazos, Salt Creek, Canes, Stakeholder, and Vaquero. And with that, I'm going to hand it off to my colleague, James Taylor, who specifically focuses on G&P assets, and he's going to walk through some of these remaining privates.
So as Jay mentioned, in this deck, we'll be doing deep dives into Salt Creek, Stakeholder, Canes, and Brazos. But on this call, however, we will just be going over our analysis of Brazos. And we can replicate this analysis for other systems and other basins. So if you're interested in something like that, just give us a call. So Brazos and Salt Creek are in the southern Delaware Basin, which are pretty active areas, while Canes is the largest system we're looking at, and one of the ones we highlight is probably the largest remaining system in the Midland. They also produce a significant amount of NGLs. It's not the most active portion of the Midland Basin anymore, being down south, but it is still a highly utilized system. And to a lesser extent, we have Stakeholder. Although it's located in the northern portion of the Delaware Basin, up on the Northwest Shelf, it's a system that recently expanded and has some consistent activity still. So when we layer these public systems over the systems we're looking at, in this deck, we can start to see which ones make geographic sense. We probably don't want too much overlap between systems, but ones that can act as extensions of existing systems and that can help the company expand into new regions of the Permian, as well as add different customers. Another factor we looked at was NGL takeaway options. As far as the integrated players capturing those NGLs, we feel these systems are especially attractive to the integrated players. So focusing in on Brazos Midstream, Brazos is backed by Old Ironsides, which has been in the company since 2015, as well as NCAP Flat Rock, which got in 2022. They currently have one plant, which is the Comanche plant, which has a capacity of 460 million cubic feet a day, and they are expanding by 200 million cubic feet a day in early 2025. So one of the great things about Brazos is they have a lot of large investment grade producers on the system, including Diamondback, Permian Resources, Conoco, BP, and APA Corp. NGL takeaway options for Brazos include both Grand Prix and Epic Y-grade, which they send about over 40,000 barrels a day between those two pipes. And given their location, as you can see up here on the map, we feel that they fit well with Kinetic, Western, Enterprise, and Targa. And we'll take a quick look at how they fit into each one of these systems here. So starting with Kinetic, both Permian Resources and APA are large customers on both Kinetic and Brazos' system. But given Brazos' more eastern location is more active than Kinetic's Alpine High system, which has not seen much activity in the past few years, the acquisition of Brazos, could bolster Kinetic's pure play Delaware position until further drilling returns to Alpine. Next, taking a look at Western Midstream, Brazos would extend Western to the southern portion of the Delaware Basin and diversify their customer base, which is currently heavily reliant on Oxy, up in the north central portion of the basin. Western is expanding capacity with Mentone 3, which just came online, and then the North Loving plant, which is coming on later this year. Brazos further expand Western's capacity, which would, lessen the need for expensive plant expansions, for Western in the future. So next, looking at Enterprise. So from the map, you can see that there is, a good amount of overlap between Enterprise and Brazos, especially in Pecos and Ward counties in the Delaware Basin. But what Brazos would provide is, more reach into the western portion of the Delaware, into Reeves County, where it's gassier and Enterprise is currently lacking, significant G&P infrastructure. But most importantly, you have the 40,000 barrels of existing NGL production from Brazos, plus what you would get from the upcoming 200 million a day expansion, which Brazos is doing. And all these volumes currently flow on Targa and Epic NGL lines. So there's a lot of value added downstream to a fully integrated company like Enterprise by capturing those volumes which are not currently on our system. So finally, we'll finish up to see how Brazos fits in with Targa. So Brazos' system is located further to the west in the southern portion of the Delaware Basin than Targa's current assets. And this area is a bit gassier than Targa's existing southern Delaware assets, which could provide a boost to G&P volumes. Also, Targa has been adding processing capacity about as quick as anybody in the Permian, and acquiring Brazos could catalyze those efforts even more, in addition to spreading out geographically, in all likelihood, adding more customers.
That wraps it up for this webinar. Again, the PDF slides will be sent out later this week, and we'll include an appendix section that digs deeper into the other transactions and privates that we mentioned today. Thank you for joining. If you submitted questions, we will make sure to get back to you this week or next. If you think of anything throughout the day, don't hesitate to reach out directly at the email listed. Again, thank you and have a great day.